Do you know which of the 3 required minimum distribution tables you will be subject to in any given year throughout your retirement? Now, this is an extremely important topic for retirees to understand because there are very few penalties within the IRS code that hurt more than an RMD miscalculation penalty. For instance, you will have a 50% penalty in the amount that you potentially miscalculate. What I mean by that, if we use an example, is let's say you had to take a $20,000 RMD in a given year and you only take a $15,000 RMD. Well, you are off by $5,000, you miscalculated. Well, you will have a 50% penalty in the amount that you miscalculated. So you will owe $2,500 to the IRS. Now, this is a completely avoidable mistake, but you have to understand which RMD table you will be subject to and then calculate your RMD properly. And so in this video, I'm going to thoroughly explain these 3 RMD tables, how to calculate your given required minimum distribution in any given year, and walk through a few examples for you to thoroughly understand the differences between each of these given tables. Now, make sure you watch this video all the way through, but if you end up liking this video and found value out of this video, please hit the like button down below, hit the subscribe button. That will help other retirees just like yourself find this video and hopefully gain similar value. So let's hit the ground running here. So the one thing that will remain consistent is the core formula behind all of these given tables. And it's pretty simple, all things considered. You're going to take your previous year's ending account balance. Okay, so let's say you have a traditional IRA. On December 31st, we're going to take the value at the end of the day of this given account, and we're going to divide by the distribution factor. Now, the distribution factor between these 3 given tables is what's going to change and adjust through time. And so first, let's cover the most common table, the uniform table. Most retirees will use this RMD table to calculate out their individual accounts, so their tax-deferred accounts. Now again, just as a reminder, you are subject to RMDs within your tax-deferred accounts and then your Roth 401k as well. And so the IRS lays out 3 specific classes of people or groups of people that need to use the uniform table. They are unmarried IRA owners calculating their own withdrawals. So if you're a single filer calculating what your RMD will be on your tax deferred accounts, you'll use the uniform table. Married owners whose spouses aren't more than 10 years younger. So if you and your spouse have a very tight age gap between the two of you, you're once again going to use this uniform table. And then married owners whose spouses aren't the sole beneficiaries of their IRAs. So regardless of the age gap, if your spouse isn't the sole beneficiary, the primary beneficiary of your IRA, you're going to use this uniform table. Now, luckily, this uniform table is one of the easiest to calculate your given RMD at any given time. Now, for those that haven't seen our previous video, it's very important to understand that the RMD tables for all of these tables updated January 1st of 2022. So distribution factors did change. If you are already taking RMDs, you will have a different distribution factor going into 2022 than you did in 2021. But I'll link to the previous video that we recorded on this topic in the upper right-hand corner here. But pretty simply, for the uniform table, what you need to do is you need to find your age in the given year that you have to take that RMD, and then find your distribution factor. So let's say that you're 74 years old. Okay, your distribution factor pretty simply is 25.5. Now, on the screen right here, it shows your withdrawal rate based on this distribution factor for those that are curious what it translates into. But we'll be talking about withdrawal rates based on this distribution factor in future videos because there's some very interesting things that we can take from these distribution factors changing over time. But let's go through a quick example. Let's say that you're age 83. Now, if we go back here to this table, at age 83, we see that we have a 17.6 distribution factor. So let's say our ending balance here is $1,130,000 inside of our tax deferred accounts. So we divide that then by our distribution factor pretty simply. Now I'm going to be rounding up to the nearest dollar just for simplicity here, but our RMD, our required minimum distribution in this given year based on our age, based on our distribution factor, is going to be $64,205. So all things considered, the uniform RMD table is pretty simple. Find your age, find your given distribution factor, and calculate your RMD as such. Now for the next table, we're going to be going in a little bit different order. So there are 3 tables. There's the uniform table, then there's table 1, which is the single life expectancy table, and then there's table 2, which is the joint and last survivorship table. Now we're going to be covering table 2 here. It makes sense as I go through each of these tables why we're covering table 2 before table 1, but let's cover table 2. So this works very similar to how the uniform tax table worked in the fact that this is for your IRA accounts. So this is for your individual tax deferred accounts. but this is a table for couples with a sizable age gap. So previously in the uniform tax table, that was used for couples that the spouse is not more than 10 years younger. Now, the joint and last survivorship table is used for owners whose spouses are more than 10 years younger and are the IRA's sole beneficiary. So again, we need to meet two requirements here. Your spouse has to be more than 10 years younger, and they need to be the sole primary beneficiary on that given IRA. Now, this table gets a little bit more complicated because these tables adjust based on your age as well as your spouse's age. So there are pages of these given tables because there can be a lot of variation between one person's age and the spouse's age. But let's go through an example here. Let's say that you're 76, okay, and your spouse is 60. So basically what you want to do with these tables is you find your age on the upper x-axis and your spouse's age on the y-axis of the given table. So if you're 76 and your spouse is 60, your distribution factor in this given year is going to be 28.6. Now, if you're 76 and your spouse is, let's say, 63, notice you have a completely different distribution factor. So your distribution factor will adjust based on that age gap between you and your spouse. But so let's go through an example here. Let's say that your age is 80 years old and your spouse's age is 65. So if we go back to this table right here, we can see age 80 and then 65. My head is blocking this a little bit. Age 80 and age 65 here, we see that your distribution factor is going to be 23.8. So now within this calculation, let's say that your ending balance from last year in this tax deferred account was $865,000. Well, again, we're going to divide in that same core formula of dividing by the distribution factor, which is 23.8, and we're going to find a required minimum distribution of $36,345. Again, we're rounding up to the nearest dollar here. So there is a little bit more complexity with the joint tables because you're looking at not only your age, but also your spouse's age. And again, the distribution factors will change based on that given age gap. But you don't want to use the uniform table because you're going to want to use this joint table. It's going to be a little bit more forgiving in terms of RMDs. Now, finally, we're going to look at Table 1, the single life expectancy table. The reason we left this till the end is because the Uniform RMD table, as well as the Joint RMD table, is for IRAs tax-deferred accounts that are your tax-deferred accounts. The single life expectancy table is going to be used for inherited IRAs, and specifically inherited IRAs for those that inherited an IRA prior to 2020. Now, the Secure Act was passed in 2020 that changed non-spouse inherited IRAs to something called the 10-year rule, meaning that now you have 10 years to use up that full IRA balance. You don't have a given RMD in any given year, but you have to exhaust that full account within 10 years. Now, for those prior to 2020, you were on old rules. You were on something called stretch rules, meaning that when you inherited an IRA, there was a given distribution factor very similar to how we calculate our own IRA RMDs, but there was a similar distribution factor that laid out how much you need to take in any given year. The old stretch rules were much more forgiving, caused you to take out much less from your inherited IRAs than the new Secure Act 10-year rule does. But at the end of the day, who is subject to this given single life expectancy table? Once again, it's going to be used for beneficiaries who are not the spouse of the IRA owner. And there is a little bit different of a calculation on an ongoing basis for this single life expectancy table. Again, we'll cover this as thoroughly as possible. But first, let's look at the single life expectancy table. Now, we're going to show a lot more ages here because you can obviously inherit an IRA much sooner than you have to take a given RMD on your own tax deferred account. At age 40, let's say, your distribution factor is 45.7. So you'll notice the younger you are, the smaller your required minimum distribution will be in that given year. Now, the thing that's very important to understand and why I said there's a slightly different calculation is because you're not going to use this distribution factor based on your age moving through time. So let's say you inherited an IRA at age 40. Okay, you're not going to at 41 be using this distribution factor, then at 42 be using this distribution factor. The calculation is a little bit different. So let's dive into what that given calculation is here. So first off, you're going to use the younger of the beneficiary's age, that would be you, or the owner's age at birthday in year of death. And what that basically means is you're going to use the younger of your age versus the owner's age. Typically, you are going to be the younger person for inheriting that IRA. Again, in most cases. You're then going to use your age in the year end following the owner's death. So for instance, let's say in 2018, you inherited an IRA and you were 55. The following year, when you turn 56, that is going to be the first year that you have to take an RMD. That is going to be the distribution factor that you find in this given table. And then for every subsequent year, you're going to decrease that distribution factor by 1. You're not going to go back to the tables. You're simply going to decrease that distribution factor by 1. So that can be a little bit confusing. Let's walk through a few examples. It's important to also know that if there are multiple beneficiaries, you're going to use the oldest age of those multiple beneficiaries. So let's go through an example to explain this a little bit more clearly. So let's say that you inherit an IRA at age 55. Now again, you inherited it at age 55. Again, let's say that's in 2018. You're first going to use the age of the following year, whatever your age is at the end of that following year. So if you inherit it at, let's say, age 55, you're going to use age 56, assuming that, again, that was your age at the end of the following year. Now, if we go back to this table here, scrolling back to these slides, so if you're using age 56 as your distribution factor is going to be 30.6. So in the very first year, it's going to be very similar to how we would calculate out the uniform tax table. We're using 30.6. We're finding that given age here on the table. So in this first year of this RMD from this inherited IRA, we're going to take this ending balance of $465,000 and we're going to divide by the distribution factor 30.6. And we'll find that our required minimum distribution is $15,197. Again, rounding up to the nearest dollar. So pretty simple in the first year. What about every subsequent year? Again, we're not going to go back to that life expectancy table. It's much simpler from here on out. We're going to simply decrease by 1. Decrease that distribution factor by 1. And we're going to do that for each subsequent year. So for instance, let's say after taking our RMD, our given account grew from $465,000 to $478,000 that following year. Now again, our distribution factor is going to change. We're actually just going to lower it by 1. So before it was 30.6, that following year that we need to take the next distribution, we're going to decrease by a factor of 1 to 29.6. The following year will decrease by 1 to a factor of 28.6. The following year to 27.6. So we're just going to decrease that distribution factor by 1 each of those subsequent years. We're not going to go back to the distribution table. Before that following year, $478,000 as an ending balance divided by 29.6. We're going to get a required minimum distribution of $16,149. So notice as we walk through these given RMD tables, there are slightly different calculations. Now the core formula is always the same. We're taking that ending balance divided by the distribution factor, but finding that distribution factor and how that distribution factor changes through time will adjust with each of these three RMD tables. But again, it's very important to know which RMD table you are subject to with each account in each given year so that you calculate your RMD properly and avoid that destructive 50% miscalculation penalty. Hopefully this video was informative. Hopefully you got a lot of value and understand which of these three given RMD tables you need to use in any given year. Always remember, you don't need more money. You need a better plan. If you gained value from this video, if you could hit the like button down below, hit the subscribe button. We release videos weekly on how you can improve your retirement moving forward into the future. Thanks for watching. Thanks for being part of this community. We hope to see you in the next video.